So our boy Tom Lee is freaking bullish on Nvidia right now. Let's listen to what he has to say on his most recent interview on CNBC, and of course we're going to break it down. Here we go.
How are you thinking about the whole Nvidia phenomenon at $4 trillion against this backdrop of just broad AI demand, as well as just appetite in the market for kind of this risk on sentiment as made evident by the Bitcoin move?
Well, to me, Nvidia being the most valuable company in the S&P makes a lot of sense. I mean, that's scarce. I mean, how many Nvidias are there in the world, right? There's 50,000 stocks. There's one Nvidia. And so it is scarcer than like Da Vinci. So I do think the multiple at around 30 times is actually not that extended given how important they are to the AI ecosystem. So I think there's earnings visibility and then there's multiple expansion potential.
So get a load of this 5-year NVIDIA chart right here, and it's freaking insane the massive move that NVIDIA did. So if we just go back to July 27th of 2020 and then go to the bottom right on the chart, NVIDIA was $9.87 per share. I get it that NVIDIA split, but this is all adjusted for the split. $9.87, which the low is actually $9.78 right here. So from basically $10 to all the way up here to $170 per share, that's a 17x. So why is Tom so bullish? Why am I so bullish? Why is AI going to sweep us all off our feet and really make us a lot of money going into the future? I'm going to break it all down in this video right here. And not to like try to get you to watch Chile in this video, but NVIDIA is one really good company, of course, to invest in. But there's another company that not many people are talking about that really determines everything for this whole AI sector. Without this company that I'm going to tell you in just a second, this whole AI ship is going to sink. So let's look at NVIDIA for a minute here. So like I said, $10 to $170 per share. You know, a lot of people were saying, oh, NVIDIA right here, it's $84 per share. It's too expensive. Wrong. NVIDIA up here at $94 a share, it's too expensive. Wrong. All the way up here at $150 per share, too expensive. Wrong. Of course, we had this dip on NVIDIA where we had the COVID stuff and everything fell and it went down to $94 per share. But geez, off of this dip right here, NVIDIA practically doubled almost up to 170 like we just said. So why is NVIDIA pumping so much? And it's really all because of one simple reason. And you probably guessed it. It's because earnings per share right here, this was going through the moon for NVIDIA. So looking back to Q1 of 2024, they were earning 10 cents per share. But if we go to current Q1 of 2026, 96 cents per share. So earnings per share is absolutely exploding. And look at what the stock price is doing also, absolutely exploding. Revenue, again, revenue is going straight up. Earnings per share is going straight up. So the key reason why you want to correlate revenue and earnings per share is because, you know, if revenue is going straight up, but earnings per share is not going straight up, it means that they're getting more business, but for something that's not profitable. So when you see revenue going straight up and earnings per share pretty much matching that, you are seeing that they are not only growing their business on a revenue standpoint, but they're becoming very profitable as they scale their business also. So that's, of course, very, very good. Now, NVIDIA is going to report earnings here in 43 days. They're usually the last one to report. So they're going to report Q2 of 2026. I realize that it's Q2 of 2025 right now, not Q2 of 2026, but they just changed around their economic calendar just to confuse us. But really, there's no value in doing that, in my opinion. It's just annoying. So the question that really everybody has right now is it too late to buy NVIDIA? Tom Lee doesn't think it is. I don't really think it is, but it's going to come down to what is your investment time horizon. If you want to buy NVIDIA all the way up here at $170 per share, but you're saying, oh, Brandon, I don't know, my time horizon for this investment is 6 months to a year, I'm going to say, look, it's going to be very bumpy along the way. I don't think 1 year is going to be a long enough hold period for that money. Because let's just say you have $100,000, you want to put it into NVIDIA and you want to buy a house next year and you need that money for the down payment. I'm not super confident that NVIDIA is going to be at $170 per share or higher 1 year from now. But if you ask me 3, 4, 5 years from right now, I'm going to say, yes, I feel very confident it will be much higher. But again, there's going to be a lot of volatility in the market. I know a lot of people were freaking out down here when the stock was dipping. People were saying NVIDIA is done. DeepSeek is going to wipe them out. AMD is going to wipe them out. China's going to take over, whatever it's going to be. But look at what happened to the stock price. It went straight up and rebounded well above all-time highs right here. We're at about 150 a share. So I think we're going to see volatility in NVIDIA. I don't think it's going to be your last time to buy below $200 a share. I think we're going to fall back down somewhere in this range over here. But again, nobody knows when that's actually going to happen. So the key is to have buying power ready to go on the sidelines. But again, when the dips happen, you have to capitalize on that. I bought shares here. I sold puts here. I bought calls right here. I capitalized very, very well on Nvidia. But now that it ran up so much, I am doing a little bit of de-risking up here at this more expensive valuation level because the chance of a pullback is becoming higher and higher and higher the more it pumps up to the wazoo.
Multiple expansion potential for NVIDIA as well as just the broader NASDAQ from here. Do you think there are significant catalysts to the upside?
Yeah, I think to the extent that there's companies that are producing durable, sustained earnings growth, whether it's the Palantirs or the NVIDIAs or the Teslas of the world, they do deserve higher multiples. And something that we've been writing about is how this market endured 6 essentially black swans in the last 5 years, thrived in terms of earnings. Normally, we would assign a higher market multiple to that. And believe it or not, the mean S&P PE, so if you do the S&P equal weight, was 17.9 on the eve of COVID. It's about 0.7 turns lower today. We're like at a 16 mean multiple, meaning the market got cheaper after 6 black swans. I almost think we should be expanding that PE.
There are some complaints this morning about, again, market concentration, right? When you got the top 10, is it 40% of market cap? Something. NVIDIA alone's almost 8%.
That's right. But then again, these exact companies are a huge share of earnings growth, So I think that the S&P is benefiting from the fact that it is sitting at the center of AI, which is a huge global driver of CapEx spend. It's going to help S&P earnings. And then the other piece is, of course, financial innovation, which is taking place. I mean, Circle and the cryptos have shown that that's another piece where there's a lot of earnings growth. And again, that's a growing share of the S&P.
All right, so a couple things to unpack right here. Tom is talking about this idea that the market went through all these negative catalysts. We had COVID, we had Trump, we had tariffs, we had all this crazy stuff that happened. And the market is still here standing back on an all-time high. So he's saying that because the market survived through all that, we now justify a higher price-earnings ratio level. That's the valuation level. Now, this is kind of difficult to unpack because it's like, just because we survived through those things, it's not like the market didn't go down during those events. Like COVID, the market went straight down. When we did the tariff stuff, the market went straight down. When the Fed raised interest rates in 2022, the market went down 35%. So yes, we survived through it. The market always survives through it. Like, the market survived through 1929, where the stock market went down like 80%. When the S&P fell 50% in 2008 for the Great Financial Crisis, yes, we survived it, but the market still went down in that time frame. So what Tom is saying is kind of true, but at the same time, it doesn't mean the market's not going to go down. It just means that, hey, we survived this stuff, but we know we're going to survive stuff. America's going to be fine in the long run. The market's going to keep trending up as time goes on. But we need to hit on this valuation chart right here just to break down what Tom is really talking about with the S&P and the NASDAQ and how the Mag 7 stocks are becoming this bigger weight of the S&P and how it's more tech heavy and how it's more expensive. Let's break all that down super quick. So again, I know we talked about this chart on the channel before, but we got a new important update. We're going to break it all down. So the Mag 7 is going to be Google, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. So these are all considered to be growth companies. They're all in the tech and AI sector, and they're all trading at usually higher price earnings ratio levels than what the overall market trades at because we're pricing in more growth into these companies. So the Mag 7 for the PE ratio is going to correspond to the pink line right here. So we were all the way up here coming into 2025, up around 31 for the PE ratio, which is pretty lofty. And then the market went down. So when the market goes down, the price earnings ratio goes down, and it went down to a level of like 22. And you can see the red line right here is the S&P. It did a similar thing from 22 down to 18, and then now back up to 22. So here's the thing that you have to focus on here. From peak to peak on the red line for the S&P 500 price earnings ratio level, this is about the same for the PE ratio, but the S&P 500 is now beyond all-time highs. So you're probably wondering, like, if the price of the S&P is at all-time highs, how is the price earnings ratio level lower than what it was before the crash that happened coming into this year for 2025 for the tariff stuff? And the reason is because earnings per share went up. So as the stock market went up a little bit, yes, that makes it more expensive fundamentally. But if earnings per share goes up, that then naturally makes the market a little bit cheaper. So as earnings per share is going up faster than what the actual market is going up, the market is naturally becoming cheaper. So I just wanted to point that out there super quick, just so you guys understand that dynamic. So overall, the point that I'm getting at is this. The market is a little bit expensive. It's not a bubble. I'm not saying it's going to fall 50%, but this red line for the S&P 500, what do you think the average price earnings ratio level is going all the way back to like 1999? Yes, it was 24 up here. Yes, it went down to like 10 over here. So if we average all this together, it's going to be roughly 17 to 18. And right now we're at 22. But again, we're expecting more growth. We're expecting these companies to grow. The Mag 7 stocks, we're expecting them to explode. More earnings, more revenue, more profit, more whatever going into the future. They're going to be more valuable. When those companies become more valuable, they're probably going to make more money and their earnings are going to go up, which would then justify the valuation level right now. So if we get that growth, great, it's justified. But if we don't get that growth, expect the market to correct a little bit lower. So right now in my portfolio, I'm very long the market. I'm very bullish on the market. But in the short term, I do think we're going to get a lot of volatility. And also in the short term, I do not have a lot of leverage options exposure right now. I have a lot of buying power on the sidelines. I think I have like $1.8 million of buying power on the sidelines right now. I'm waiting to capitalize when it makes sense. Maybe we get more clarity from earnings as they come through and it's going to make me more bullish, but maybe we don't. I'm in a game that I don't have to make a decision if I'm not 100% sure, and I'm just going to sit here and wait and be patient for something big to strike. Yes, I'm still making plays. Yes, there's things to capitalize on, but overall, it's a tougher market right now than what it was a few months ago because, of course, it was cheaper. Now, I talked about this other stock that is really good, and I think it's really one of the best stocks to buy right now, and it's going to be TSM, Taiwan Semiconductor. And just very quick, if you want to get my breakdown on TSM, just watch the video that I posted before this one, the long-form video that I posted before this one. So basically, TSM is just a manufacturer for all these AI and data center chips. They control over 90% of the market, so they pretty much have a monopoly. So NVIDIA and AMD, they design the chips. TSM builds the chips. So you can't get these chips without TSM. So do a little bit of due diligence with TSM, do some research, watch some videos, read up on a company, read the financials, listen to the earnings call. You're going to get some good information about TSM and if you should invest in it or not. I personally have a lot of exposure to TSM. I love it. Of course, China could invade Taiwan and it could wipe us all out. Very unlikely, but I'm going to end it right there. If you want to get my course, you want to do my Discord, you want to learn my entire system that scaled me to millions of dollars and hundreds of other people just like you, click link below. It's going to change your life. It's 100% free right now, but only for a few more days. After that, it's going to be charged for. And if you don't want to do that, watch this video right here. It's breaking down everything going on in the market for this week with regards to earnings and what to look out for. I'll see you guys there.